In this tutorial, we're going to take a look at the area of ratio and financial analysis. So again, I'm assuming you've read through the question. If not, please read through it and ideally make an attempt of it before you take a look at the recording. So we have three main requirements here. The first one is to calculate 2, 4, 6, 7 ratios for both years. So again, although we don't focus and tell you what particular aspects of financial performance and position we're looking at, you're clearly given three profitability ratios: gross profit margin, net profit margin, and ROCE. You're given a liquidity ratio, current ratio, and you're given an efficiency ratio, trade payable days, and two gearing ratios, which is to do with your capital structure. So again, you should use the idea of the questions will always guide you what aspects of the financial performance that the question wants you to focus in on. And we've given you here sample ratios, and we've also given you up here industry averages for those same ratios. So they're the key ones we want you to focus in on. Then part B is looking at the interpretation and analysis of those ratios. So critically evaluate the performance position of MedWorld for 2016, 2017 and compared to the industry averages, and briefly comment or discuss how your commentary in B will contribute to discussions for the Coronto team regarding the desirability of acquiring MedWorld as a customer. So that's the context if you've read through this question. Coronto is the company that's possibly getting MedWorld as a new customer. And what you want to figure out is this going to be a financially worthwhile customer, right? Do they have a good financial position, or are they going to struggle to pay their debts, and i.e. to pay Coronto as they purchase goods off them? And then you're told what other financial and non-financial information would you consider when assessing the desirability of acquiring MedWorld as a customer. So we're looking for what other information might be useful. Because we're only given a set amount or a discrete amount of information in the exam question, we want to see the students have an appreciation what else might be useful and why. So the background here, as I mentioned, and you should have read through, is you work in the credit control department of Coronto. MedWorld has approached them to be a new customer, and they want to make a significant order for the coming 3 years, representing 30% of the capacity of Coronto's refurbished facility. So this is a particular one, and they want to get a 10% volume discount because they're buying so much, and they want to get trade credit. So they want to have to pay after 60 days, so 2 months credit. Now there's been mixed views within the company. Some think it'll be good and it'll help them open up the doors for further growth. However, other people are a bit more concerned because they've heard stories about MedWorld in terms of supplier payment issues, and maybe we'll see that coming out in the ratios, and governance issues as well. So what you're asked to do then is analyze the financial performance and position of MedWorld and figure out, does this look like a good customer or not? Will they be able to pay their bills as they fall due, or are we going to end up getting in a difficult relationship with a customer that won't pay at all, or at least won't pay on time? So we're giving industry averages, and you'll note those industry averages are for the 7 ratios that you're asked for in part A. So we'll use that for context to benchmark them. And we're also told extra bits of information that a good student should be able to bring in to the analysis and tell a story. So MedWorld recently refurbished its manufacturing facility for €2 million. They continue to pay 1.5 million dividend every year to the Clune family. And based on recent company filings, 2 independent directors of the company have recently left due to disagreements over the use of company resources. So things like that you're going to bring in to tell a broader story about whether or not this will be an attractive company to sell 30% of your capacity to. And not only will you be selling it, you'll be selling it on credit for 60 days. You're not going to get the cash up front. So whether or not this is too risky is something you have to decide on. So the first thing you'll do before you calculate any ratios is do a high-level look at the financial statements. What are the key trends you see? Because this will help you identify what some couple of comments that you're going to make in part B. If you just jump straight into the ratios, you're going to end up missing some very valid, broader points that'll be useful in terms of coming up with a conclusion of whether it's an attractive company or not. So we can see in MedWorld, they're growing revenue marginally year on year. Gross profit is falling. Operating profit is falling significantly, and net profit, it's nearly a loss-making company. It's now gone from 1.2 million profits in 2016 to 80 grand in 2017. So the big issue here seems to be cost control. Big jump is in wage and salaries, big jump in directors' fees, big jump in interest costs as well. And all of that is contributing to a very poor profitability in 2017. Good student might say perhaps some of that is because of the refurbished facility and it's taking longer to bed in. But again, we need more information about that to make a firm conclusion. Your key thing is revenue is growing slightly, but costs seem to be growing a lot quicker than revenue. So cost control seems to be a big concern in the organization. In the balance sheet, you can see big investment in property, plant and equipment, which we know is reflected in the new facility that was spent 2 million on in 2017. Inventory is going up, trade receivables significantly going up, and cash has gone from 1.5 million in cash to 1.1 million in an overdraft. So that is a decline of 2.6 million in cash. You went from positive 1.5 million to negative 1.1 million. So again, there's a huge drain in cash here. We can see the bank loan is due for repayment in 2019. So the context here, it's due very soon. Will they be able to refinance it and repay that loan back? If not, it could cause a big issue financially for the business. They took a new loan out, it seems to be in 2017. That was either to part finance the manufacturing facility, or a good student will notice it's probably to part finance the dividend as well, because you had very little retained profits to pay dividends out in 2017, but they still paid 1.5 million. So it looks like they're financing their dividend payments through debt, which is always a difficult position to be in and probably not sustainable in the long run. And likewise, what we can see is trade payables are significantly increasing. So we're going to look at that when we calculate our ratios as well. So certainly at the start, do a high level look at the financial statements. What is profitability moving? How are revenue and costs moving? Are assets going up or down? Is your debt going up or down? Is your cash going up or down? They're the key trends, and clearly from this position, it looks like MedWorld is a company that's struggling financially in 2017, taking on more debt, paying out dividends, even though profitability, the company is nearly loss-making, and cost control looks to be a big issue. So you're just jotting some of these little points down because you're going to use those in part B when you're making your critical evaluation. You're discussing the position and performance of the company to get your marks. So we're going to focus now on part A, and you're going to lay it out in a nice and neat table. So if you can do it in Excel, you can do it in Microsoft Word, but we're just going to lay out the ratios, and we're going to do 2017, 2016, and the industry average. And we'll do gross profit margin, net profit margin, ROCE. So it's nice to have a little table because you can cross-reference it back then. Your current ratio, we have trade payable days, we have gearing, and we have interest cover. So again, it's important for you to practice as you understand what each of these ratios mean, and we're looking at different aspects of financial performance as well. If you can lay it out in a table like this, you can use Microsoft Word table if you want as well. Show your formula. So you don't need to show the formula in narrative form, just show your calculations as you go down through them. And we'll talk about each of them as we go. So we're answering a lot of part B as we go in part A. I'll talk you through what each of those mean. So when we come to part B, we can just talk about the structure of the answer and what's the best way to lay it out to maximize your marks. So your gross profit margin here, that is your gross profit divided by your revenue. So how profitable are you relative to the sales that you make? So it's 5.9 over 17.3 and 6.3 over 17.2. So the answer is in percentages. So here, 5.9 over 17.3. Again, you can multiply by 100 over 1 if you want. This is in percentages. So just put that in percentages. So 34% or 34.1 if you want to be exact. Then it is the previous year, 2016, was 6.3 over 17.2. And that is 36.6%. So profitability has deteriorated year on year. And the industry average we're given the question is 35%. So you've gone from above average gross profit margin to below average. And the big thing there looks to be cost control. Your cost of sales are growing quicker than your revenue. So key things like that is what you're going to comment. You're not making comments in part A, but we're covering them as we cover them here, so we're not duplicating ourselves in part B. So profitability declining, not a huge amount, but still will be a concern. Net profit margin is net profit still over revenue, Margin is a profit figure divided by revenue. So 80 over 17.3, 1210 over 17.2. So this is going to be very low because you're making very small profits, not even 1%. So 0.4% or 0.5%. So 0.5% in net profit margin. Last year, it was much higher, 1210 over 17.2. Last year, it was 7%. Right? So it's been decimated period on period over the last year. You've gone from 7%, which was actually lower than the industry average, but not by a huge amount, to down by 0.5%. So, and this is important that students can watch for this then. So we're saying here you're just below the industry average, whereas here you're way off the industry average. So one big problem looks to be between gross profit and net profit, i.e. your expenses. The growth in your wages and salaries, the growth in your director fees, the growth in your interest, which we know because we've more debt now and we've more overdraft, which means we're going to have more bank interest. But that seems to highlight, by calculating those margins, yes, gross profit margin is declining, but it's nowhere near as far away from the industry average as net profit. That's a big concern. And the expense management, directors' fees, wages and salaries seems to be growing too quickly. So you may need to look at those costs in the context of where the revenue is in the company. So you're picking up these points and you're telling a story as you go through. Return on capital employed looks at how profitable the company is relative to the capital in the business. So you take your operating profit, 750 in 2017, and you divide that by your capital employed. Now, capital employed, if you go back to your formula, is long-term debt plus equity. So it's the 6 million plus the 5680. So we should really be knowing these formulas now. So operating profit, which is profit before interest and tax, over your long-term capital. So the answer there, about 6.4%, is your return on capital employed in 2017. So that says for every euro you've invested in capital, you're earning a profit of about 6.4 cents. Previous year operating profit was here 1780, much higher, and you had less debt, but you had more equity, 45 and 71. So what you have here is 1780 divided by 45 plus 71. And that is a return on capital employed of 15%. So your return on capital employed has more than halved. What's driving that is the increase in debt and the reduced profitability. So there's two factors driving that. And we know from the question the actual industry average, if you go back, is actually 18%. Your competitors are earning an average of 18% return on capital employed. So the company now is way off that. It's much lower profitability. Now again, a good student might say maybe this is a temporary blip because of the new manufacturing facility that was invested in 2017, and maybe it takes time to get bedded in. And that's a valid point that will gain a half mark in the exam, that you realize we don't have all the information, but it doesn't look good based on the current reading of the financial statements and the current calculation of ratios either. So this is looked at profitability. And when I talk about in part B, those first three, I'm going to color code them. They are going to be part of your profitability section discussion. Profitability has declined in all three instances, all ratios. You're worse than the industry average and it's deteriorating. So that would be a concern. Liquidity then, short-term cash position, is looked at in the current ratio. This is current assets divided by current liabilities. So how much short-term assets, current assets, do you have relative to your short-term liabilities, which is known as your current liabilities. So it's simply one divided by the other. 6 million, be careful to take the right one, 6 million current assets, 4680 current liabilities. So it's 6 million divided by 4680. So the answer there is 1.28. So you have €1.28 in current assets for every euro in current liabilities. So you've just about covered them. Whereas last year, your current assets were 5.4, your current liabilities were only 2. So that was 2.7. So what we're saying here, this is a deterioration in liquidity. It's gone from 2.7 down to 1.2. You have less current assets relative to your current liabilities. So you may struggle to pay your short-term liabilities, which are your overdraft and your payables. So if either your bank starts looking for their overdraft back, or your trade payables start looking for money, as we kind of figure out in the question they are, because there's issues around supplier payment stories, you could be in trouble as a company, i.e. MedWorld. So remember, we're looking at MedWorld as a potential customer. Will we sell these goods on credit? We will become a trade payable of this company because they will owe us money. They will be our trade receivable, but we will be a trade payable to them. So that's a concern that looks like they cannot pay. And the industry average is 2 times. So you are below the industry average. Lower is worse when you're dealing with liquidity. A higher current ratio means better liquidity. So I'll put that in orange to signify that is a liquidity ratio. And that would be a concern. It is deteriorating as well. Trade payable days is to do with what we call efficiency. So what we're looking at here is we're trying to say, well, how long does it take the company to pay its suppliers? And of course, that's particularly important for Coronto because you are going to be a trade payable of MedWorld if you sell to them on credit. So we want to know, from Coronto's perspective, how quick are MedWorld at actually paying their customers, or paying their suppliers, of which we will be one. Trade payable days is trade payables. Here, 3530 divided by cost of sales. If we had purchases, we might use it, but we don't. We only have cost of sales, 11.4 in positive, and then times 365. So 3530 divided by 11.4 times 365. So 113, the answer there is in days. So what we interpret that, and again, you need to know your formulas to do well in this section. It's taking MedWorld 113 days on average currently to pay its suppliers. That should be a big red flag to you because our current proposed offer from MedWorld is to pay us within 60 days. So they're nearly taking twice as long to pay their current suppliers. So what gives you the indication that you're going to get preference Coronto if you start selling to MedWorld? That is a big concern. In last year, this was 2 million over 10.9 million times 365. So last year they were taking 67 days. So 67 days, just over the 2 months. Now, at a high level, some people might say, well, that's an improvement because you're taking longer to pay your suppliers, which means you're getting a free source of credit. So maybe you might argue that they're being efficient in managing their working capital. That is one aspect, but the problem here is if you look at the financial statements as we've done, it gives you an indication why are trade payables increasing. It's because they've no money to pay them. They have no spare cash and their overdraft is running up quite quickly. So one stakeholder that gets impacted when you have a shortfall of cash or liquidity problems are your suppliers. It's not that you're negotiating longer credit terms with your suppliers and you're being very efficient. It's that you physically cannot pay them. So you're delaying payment and that means you're going to get very unhappy suppliers, which is mentioned here in the question. The news stories in the media about supplier payment issues. That would be a big red flag of someone who's thinking about selling to this particular customer. They cannot pay on time. So if you're going to sell them goods on credit, you may expect to get delayed payments or maybe even some bad debts. So that's a very important ratio when the industry average, you're told, is 60 days. So you're told the industry average is 60 days. You're promised 60 days from MedWorld, but they're currently taking 113 days to pay their suppliers. So that should certainly be a red flag to think maybe this is not a good customer to get involved with. They're not going to be able to pay when we expect them, and maybe we're going to lose out then. So the last key section we're looking at, I'm kind of keeping them in separate because the examiner gives you the ratios to help you along. Some exam questions will tell you for example, assess MedWorld from profitability, liquidity, gearing perspective, and you will be expected then to come up with the ratios yourself. This question took the opposite. It gave you the ratios, and you have to remember what types of categories or areas are each of those ratios looking at. Profitability, liquidity, efficiency, and the last one is capital structure, i.e. how the business is financed. So these questions can come up in different formats. So in the gearing ratio, we're looking at what percentage of the business is financed by debt. So it's debt over debt plus equity. So in this year, your level of debt has gone up to 6 million and your equity is 5.6 million. It's going down because you're making small profits, but you're paying big dividends out. So that's why your shareholder funds are declining, because you're taking huge dividends out of the business, but you're not making that much profits. So it's a net decrease overall in your equity. So in this case here, it's 6 million debt over debt plus equity. So what percentage of your business is financed by debt? The percentage here is 51%. So over half of the business here is financed by debt. So not hugely big compared to the industry average of 50%, but there is other concerns that we'll see in a second. Last year, the gearing, debt was only 4.5 million and equity was 7.1 million. So 4.5 over debt plus equity, which is 4.5 over 11.6. It was 38%. So your gearing has increased year on year, gone from 38.8 up to 51, but you're not highly geared here. You're in and around the industry average. So from a debt perspective, debt versus equity, it's not a concern, but we have mentioned a number of other concerns already that would be an issue. Lower profitability, poor liquidity, poor trade payable payments. And one other way to look at the capital structure here is not about the proportion of debt in the business, it's about the affordability of interest. And we call this the interest cover. We look at how profitable you are relative to the interest expense. The higher the better here, that the more cover you have, or the more affordable or sustainable your interest expense is. And the formula for interest cover, if you have it in your notes, is operating profit, which is otherwise known as profit before interest and tax, divided by the interest expense. So for 2017, operating profit 750, interest expense 650. So it's 750 over 650. That means your interest cover here is 1.15 times. So you've just enough profit to pay your interest. That's not even including the loan repayments. So 1.15, that's quite low when you think the industry average is 5 times. And last year, when you had much higher profits, you had 1780 over interest of 400. So last year, the interest cover was 4.4 times, much closer to the industry average. So the main driver of the deterioration in interest cover is twofold. Your interest is going up, and that's going up because you have more debt and you have a bigger bank overdraft, which of course you pay interest on. And your profitability is falling rapidly. So it's having a double impact on why your interest cover is falling. So while gearing is fine, your interest affordability looks questionable at the current profitability rate levels. If profitability is expected to bounce back, then it might be a bit more affordable, but currently it is quite tight. And any increase in interest or any decrease in profits could mean that you can't afford to pay your interest. And that could have big ramifications for your relationship with your bank. All right, so hopefully that makes sense to people so far. So what we're going to do now is we've answered part A, and I like the idea there, if you're asked a question like this in an exam, lay it out in a tabular format. Columns so you can easily relate to them, and then what it also does is it makes part B of the question a lot easier to answer. Because now you can look at the section and say, right, I can see them clearly here, I can make informed comments as I go along. So what I'd be looking for in terms of part B here, critically evaluate the performance and position of MedWorld. I don't want a big long rambling paragraph here. So for B, and you can see this in the suggested solution, I would expect bullet points are fine, and I'd expect headings. You do a heading profitability, which is going to cover gross profit margin, net profit margin, and ROCE. You have one on liquidity, where you discuss the current ratio. You have a section on efficiency, which you talk about trade payable days, and you have a section on gearing, where you talk about the gearing ratio, and you talk about interest cover. So the better students will lay it out in a nice structure like that, and they'll get a lot of marks. Keep it in 4 headings, and all the points that I've made up here, the points about poor profitability, the points about cost control, the points about deteriorating current ratio and having poor liquidity, the problem with increasing trade payable days and how it's so out of whack compared to the offer that MedWorld have made. All of those points will be made there. And there's nothing wrong with using bullet points. Now, I don't want to see a bullet point in an exam solution that's 2 or 3 words long. I want to see a bullet point that's a sentence or 2. So you develop your point, but you link it back into the facts of the case. Right? That's where a good student will differentiate themselves from an average student, is you lay it out appropriately. I give you a kind of general requirement, but you use that information to make it structured. And that allows you then in part 2 to discuss how your commentary here, how does this information about how the company is getting on inform your decision about whether MedWorld would be a good company or not, a good customer, should I say. So if you're thinking from B part 2, and again, I have a detailed solution put up on Loop, so you should be able to see that. What are the key things? I want you to think about it from the perspective of, is this a good customer to have? There'll be plenty of other ratio questions where I'll ask you to think about it from the bank's perspective or from a shareholder's perspective. Here, I want you to think about it from, should we sell to this company? And the big probably answer here is no. They have big liquidity issues, so they may not be able to pay when they owe us money. They're taking an awful long time to pay their suppliers, of which we will be one. So they promised to pay us in 60 days. They're only currently paying their suppliers in 113 days. So who's to say that they can actually improve on that? Their interest affordability looks questionable. Right? They've only got 750,000 euro profits to pay 650,000 interest. That doesn't look sustainable in the future. And if you look down here, their bank loan is due for repayment in 2 years. Will they be able to refinance that? If not, they could be in big trouble with the bank. And that could result in a very difficult situation where if we are selling on credit to them significant amounts of product, we may end up having bad debts and having to write off some of the money that we owe them, or that they owe us, should I say. So overall, their cash position, their profitability issues, and their governance issues, and a good student could say that, the fact that they continue to pay 1.5 million a dividend, and the fact that they're having rows with independent directors who are supposed to be there to help govern the overall organization, would give you a bit of a bad taste to say there's something wrong in this company. They're taking on extra debt to take out dividends for the family business, and it's putting the business in a very precarious position. So it probably looks like here, this is not a good company to sell on credit to currently. Good student might say it might be an idea to sell them to on cash, give them no credit for the first while to see that they prove it, can they pay it, and you build up a relationship and then maybe offer on credit eventually. But if you do as they suggest currently here, you give them 30% of your capacity, huge orders, you give them a 10% volume discount, and you give them 60 days credit, they may not pay for 120 days. And you may not get the money at all if they have problems with their banks or they continue to have problems with their cash flows. So in terms of your overall approach here for B part 2, it looks like a negative answer. But you have to use your answers to support. Talk about trade payables. Talk about interest cover. Talk about governance issues and the dividend payment even when you're just about break even. All of that information is going to feed into the overall conclusion that really, in its current situation, it doesn't look like an attractive customer. It's probably going to be worth more hassle and more problems than it's worth. But that's where a good student can tell that story from a particular angle. We look at other tutorial questions and questions in the question pack, which will look from the bank's perspective, they look from a supplier's perspective, or they might even look from a shareholder's perspective. So that's the key thing with ratios is it can be from a number of different perspectives, and you'll use different ratios to tell a different story and come up with recommendations. The final piece here then was discuss what other financial and non-financial information would be useful. So what would you want to know? And go back and look at the solutions here. But for example, in terms of financial, look, we've no cash flow statement. That would be a useful resource. What is the cash flow statement? Now we'll cover this later on in this module, but where is the cash going? Where is the cash being used? And how do we go from 1.5 million positive cash to 1.1 million bank overdraft? We have a statement that actually says that. Other financial information you might want to know is the budget. What's the budget looking like for 2018 and 19? Is this a one-off due to the new manufacturing facility? And does the company expect to turn around profitability in 2018? Right? Maybe you want previous years, 2015, for longer term trend analysis, or you might want more detailed information about the trade payables, a breakdown of why those trade payables are increasing, and an explanation of why it's deteriorating so much. So there's plenty of flexibility in a question like that, but you have to give financial information and non-financial. I've talked about a lot of financials there. More financial statements for previous years. Look at a statement of cash flows. You might want budgets going forward to see what the plan is for the future and how it's changing. But we also want non-financial information. And this is where a good student can differentiate themselves. So if you're thinking about getting on a new customer, what type of non-financial information would be helpful? So things here, and you'll see these in solutions. For example, trade references will be a useful one. So this is where you go and ask MedWorld and say, well, that's fine. I want to get 2 references off you from other suppliers that you buy off. So are you a good customer? Do you pay on time? It's like you're getting bank references or work references. Get references for the company, right? You might want to get information about the governance structures, which is non-financial. Like, what are these problems with the governance? Why are the independent directors leaving? And is this true in the media? Because you don't want to get involved with a business who has a lot of scandals or management issues going on, which can result in, again, financial problems down the line, and you being left to write off bad debts. Right? So you might want to get an idea of their governance issues, trade references. You might want to get an idea, for example, here, what's their trade payment supplier policy? So you're offering me 60 days. You might want to ask them, how are you going to meet that? Because your current trade payable days are 113. So that's more non-financial information, asking them, what is your supplier payment policy? Right? Are you a good prompt payer, or do you take too long to pay, which means you have disgruntled suppliers, and that's why they're coming looking to buy off you? What happened to your previous suppliers? And a good way to catch that is to ask them for trade references. Because if they've fallen out with their previous suppliers, they won't be able to get trade references, which will be a good indication they could be a problem customer. So I said, I'm just trying to talk you through some high level things to think about, but you go back and look at the suggested solution that is uploaded to Loop as well, which will give you more ideas. But there is flexibility in those types of requirements that if a student gives a valid answer, even if it's not given in the suggested solution, you will still get credit. So don't think just because your answer is not there, it's not worth marks. So this was a nice exam level question looking at ratio analysis from a particular perspective, i.e. deciding whether this company would be a good prospective customer or not. And you can see some of it is about calculations, and you need to lay those out neatly and show the examiner where the calculations are coming from. But a lot of this is about narrative as well, about you telling a story, linking the ratios together, and linking the ratios to the narrative information and the financial statements that are given in the question as well. Now that is not easy, and that takes time to practice, but the more questions you go over in tutorials in the question pack, you will get more comfortable around calculating ratios and, more importantly, interpreting them, analyzing them, and then giving recommendations. So that was this week's tutorial on ratios, otherwise known as financial statement analysis.